gold itself is holding very, very strong, but silver is not, gold stocks are not, silver stocks are not. And we know the reason for that. The reason for that is one thing and one thing only. And that is when you look at who has been buying gold assets in the last 18 months, and it's been central banks. Central banks want to buy gold bullion. They don't really want to buy silver bullion, and they definitely don't want to buy Newmont Mining or Ajax Exploration. They want to buy physical gold. And that's why gold is doing so well, even in the face of the gold market, otherwise being very, very weak. I think it's important people realize that's why gold is holding up in the face of everything else. Gold coins, gold ETFs, silver stocks, everything else going down.
Adrian Day, a notable figure in asset management and the founder of Adrian Day Asset Management, has recently pointed out a disparity in the performance of gold compared to silver and gold mining stocks. Day attributes this to central banks' preference for gold bullion over other precious metals. Throughout 2023, gold experienced a significant increase in value, reaching an all-time high of $2,135 in December. However, expectations for continued growth were met with a different reality in the first 2 months of 2024, despite gold maintaining a strong position above the $2,000 level. Recent developments amidst ongoing economic challenges have had a positive impact on gold. Day suggests that the current price of gold may be excessive considering the economic landscape, particularly with rising interest rates and a strong U.S. dollar. Bob Haberkorn, senior market strategist at RJO Futures, explains that gold's recent uptick may be partially due to a weaker U.S. dollar. He remarks that the precious metals market is balancing safe haven buying and the high interest rate environment. Concerning interest rates, Fed Governor Christopher Waller has stated that central bank officials are not in a rush to implement cuts, with experts now predicting a delay in rate cuts until June, a notable shift from earlier expectations of cuts in March. Day emphasizes that geopolitical events, despite causing a short-lived spike in gold prices, such as the 9/11 terrorist attacks, typically have only a temporary impact. Gold prices on the London market rose from $271.50 to $287, or almost 6% in one day. Join us as we explore the insights shared by Adrian Day. Stay updated by subscribing to our channel and activating notifications. Thank you.
Over the last 18 months, we have had steady outflows from global gold ETFs. I don't mean every single week or even every single month, but on balance, for the last 18 months, we've seen money flow out. And this year, up until February 15th, latest data, this year, been 42 tons outflows of gold ETFs. That's more than all of last year's outflows. So those outflows are continuing. So I think it's important people realize that's why gold is holding up in the face of everything else. Gold coins, gold ETFs, silver stocks, everything else going down. I think that it's gold. Everybody talks about the disconnect between gold and gold stocks.
Right.
I think it's gold that is too high for the current economic environment. Now that's changing. But if you look, say, 3 months ago, you had interest rates moving up dramatically, not just in the US, but in other countries around the world, in Europe, even in Japan, they're moving interest rates up, for goodness sake. If they keep on at this rate, they might get to zero pretty soon. So interest rates moving up and a strong dollar. Well, that economic environment is very negative for gold. In addition to that, so I would argue that the disconnect between gold and gold stocks is not the gold stocks are too cheap, but the gold is too expensive for the economic environment. Now, the economic environment is changing. So that's good news. But when you ask why have gold stocks been so weak, I think that's part of a reason. And the other part of a reason, frankly, is that the broad market is doing so well. People often say to me, oh, gold's doing well, the stock market's doing well, why aren't gold stocks up? And there's a false premise there. Gold stocks will typically do well. I think gold stocks will do well when the rest of the market stumbles, not when it crashes.
Right, because
everything goes. Yeah. If the market starts to falter, that's when I think we'll see some interest return to gold. But getting back to your original thing about the Fed, I mean, history tells us that when the Fed starts to cut after a raising cycle, gold moves up. And that's happened every time. There's no reason to think it won't happen again this time. So that's what we're really looking for. Typically, geopolitical events, they have only a short-lived impact on the price of gold. When something happens, there's normally a spike. And frankly, you often see gold moving up if it's something that's predictable, like the Russia's invasion of Ukraine was I mean, I got it wrong. I didn't think they would invade, but I mean, it wasn't something that came completely out of the blue.
Yeah, you knew that you knew that for like weeks.
Right. And so gold was moving up ahead of that. Within 3 months, it was back to where it was before that. And that is before the whole thing started, the crisis started. And that is not an untypical pattern. Notice how Brits speaking with double negatives. That's not an untypical pattern. You know, even 9/11, that was completely unexpected, had only a short-lived impact on the price of gold. Typically, if gold's already in a strong up move and you have a geopolitical event, that's, if you like, icing on the cake, and it can be a much bigger move. Like with the Iran hostage situation in 1979-80, gold was already flying. But ever since then, geopolitical events have been a very minor impact, to be honest. They have a bigger impact on other commodities, but where the supply might be directly affected by what's going on. So phosphate with Ukraine and Russia. That's a prime example.
Adrian Day has suggested that even with the ongoing efforts of the Federal Reserve to combat inflation, stubborn inflation numbers are likely to persist and potentially even escalate further. However, Day does not foresee a scenario of runaway inflation. Notably, a core measure of the Consumer Price Index surged by 0.4% in January, contributing to an annual increase of 3.9%. This has prompted some economists to adjust their predictions for when the Federal Reserve might make its first interest rate cut, extending the expected timeline from May to later this year. In light of these challenges, Adrian Day believes that the Federal Reserve must take steps to ease its monetary policy. However, they did not specify how such easing might be implemented. Fed Vice Chair Philip Jefferson has acknowledged the strong actions taken by the Fed thus far and their impact on policy rates, suggesting that these actions have led to a restrictive monetary stance. This, in turn, is exerting downward pressure on economic activity and inflation. Let's get back to the interview.
The insurance companies that are insuring the banks for the losses, or insuring the commercial real estate developer owners, landlords, you know, they're going to have a problem as well. Yeah, you're absolutely right. I mean, the Fed, there's always a dilemma, right? There's always, if we do this, there's a risk. If we do that, that's a risk. But right now, the Fed really has a huge dilemma. As you say, if they lower rates, then the inflation numbers are only going to pick up. I think they're going to remain stubborn and move up. I'm not talking about accelerate, or I'm not talking about runaway inflation, but they're going to move up anyway.
Right.
But if they lower rates, that only exacerbates that problem. And that's really, I guess, that's really the only downside for the Fed. I'm not talking about, you know, fundamental effect on the strength of the economy, but that's really the downside for the Fed at the moment to lowering rates.
Right.
But on the other side, the downside to keeping rates where they are for any period of time is not only a recession and higher unemployment, but as you say, is commercial real estate and then banks and potentially the insurance or some insurance companies, which are heavily exposed to CRE. And then the other downside, of course, is the federal government's debt levels, which even if you keep rates where they are, that means a huge increase in the amount of the percent of money in the federal budget that is going simply to interest payments.
Right.
So if we keep rates where they are for a while, that's going to increase by, I don't have the numbers in front of me, sorry, but that's going to increase by at least 50% over the next 12 months, just if we keep rates where they are.
Wow.
So I think on balance, the Fed knows that they have to ease. And there's different things they can do, you know, with bank reserve requirements and with, you know, there's different things they can do, but it means overall they have to ease, and that's bad for inflation.
The latest Kitco News Weekly Gold survey showed Main Street holding steady with a relatively balanced but overall bullish posture heading into the final week of February, while Wall Street analysts abandoned the bear cave to gear up for another projected bull run. What key indicators or developments should investors closely monitor in gold in the near term? Share your thoughts in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.